there's a big advantage of being geographically diversified and having that global view. And that's the decision that we've made so we can be flexible. And by the way, if we decide to pull out, I don't have to worry about laying off 200-300 people who are in property management and construction, because that's not the business we're in.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Michael Episcope co-founded Origin Investments in 2007. He co-chairs the investment committee and oversees the investor relations and capital raising departments. Michael, welcome to the show.
Thanks, Sam. Thanks for having me.
Pleasure's all mine. Same three questions I ask every guest who comes on the show. Can you very quickly tell us in 90 seconds or less where you started, where you are now, and how you got there?
Yeah, sure. I'll try to keep it to the 90 seconds. So my partner and I, we came out of a different background. We were both commodities trader. And in 2007, we formed Origin, and we were both passive investors prior to that. And it was really out of this need, as we saw it, to build an investment firm around our own capital for the needs of individual investors, and marrying what we saw as best practices on the institutional side, but also for the individual investor. So we always wanted to sort of scale the organization. And in the beginning, and it's still somewhat the same, it was about investing our own capital, finding our own deals, building scale around that. And that's, I think, what attracted a lot of investors to us during the beginning times and even today. So we've invested, more than, I think, $65 million today across all of our funds over the last 14 years next to investors. And that alignment really matters in terms of not only, from the investor's perspective, but all the decisions we make about what funds we want to bring out, about, what deals get approved, et cetera. So we've had really exponential growth over the last 5 years. And in about 2015-16, we made the decision to apply marketing and technology to what we already knew was a great product. So at the end of 2015, we had 75 investors, and we took advantage of the Jobs Act and being able to market. And we went from 75 investors in 2015 to about 500 investors in 2017. And then we had a brief period there where we weren't marketing because we had a closed-ended fund. But in the last 3 years, we have now 4 funds, or 3 and 1 on the way. And we're up to 2,400 investors. I'm very proud. We've had great success, top decile to top quartile manager in every single fund that we've deployed. So it's been quite a run. Hopefully that's under 90 seconds.
Oh, that's fantastic. I mean, there's so many questions that come, out of that. When you say the Jobs Act, can you break down what it was that was in the Jobs Act that you guys said, hey, that's an opportunity for us?
Yeah, it's kind of interesting because if you go back even in the 1930s, so coming out of the Depression, the SEC created these rules that only allowed accredited investors to invest in private investments. So you had to be accredited, you couldn't market, you couldn't do anything. And the idea is that they were protecting people, right? The small individual from, getting into something that they were over their head. And so, I think what they learned is just because you have money doesn't mean necessarily you're sophisticated. And just because you don't have money doesn't mean you're not sophisticated. Right. And so what that really did is it bred a lot of opportunity for the Madoffs of the world to survive. And so the Jobs Act actually stripped that down and said, look, we're going to allow the market now and people to openly market, to let the crowd decide what they want to be in, and open this up to a much wider swath of investors. And I would say that it's probably the single best thing that the SEC did, is opening up that market and creating the transparency, because candidly, like, bad investment firms are mediocre. They cannot invest or exist in this marketplace today. It just doesn't allow them to, because of the transparency of the crowd and how much information is passing back and forth between them. So we use that to really be able to market back in 2015 and 2016 and jumpstart Origin into what it is today.
Right, man. That's absolutely intriguing, because you're right. There were, now you can openly market, but you guys, as opposed to maybe the old style of, hey, the guys, the people, just your friends, and then that bigger network beyond that, maybe people at the club or wherever it is that now you can openly market on the internet, right? Is that what we're talking about?
Absolutely. It's scaling the business to a point where if it's just me and my partner going out there, there's only so many lunches and dinners and phone calls that you can make in a day. But the internet allows us to get our message out there broadly to hundreds of thousands, even millions of people. And the idea is that you create this funnel. It's a lead generation funnel. And then what you're doing is you're getting people who are interested in buying your product. I don't, really consider it a skill. We're educating people on real estate. We have over 400 pieces of content all around education to really educate the investor universe about how to be a better investor, how to invest astutely, demystifying what's happening in the commercial real estate market. And that's, if you have a great product and you get it in front of a lot of people, you're going to sell more, right? So it's a very simple solution or simple formula that's been used in other industries forever. And that's all we did is apply it. It's not rocket science. It just makes sense.
Right. Yeah, absolutely. I love that. That's absolutely fantastic. What are some lessons? I mean, starting in 2007 is a very interesting time to get into real estate and to launch a real estate investing firm. What did you guys do 12, 18 months in when all of a sudden it seemed like the world came to a crash?
Yeah. Well, we were, like you got to get a little lucky in life. And I think 2007, we were a little lucky getting in. And had we gotten in 2004 or 5, it might have been a very different story, because in 2007, again, it was only our money. We had this fledgling idea, but it was really about how do we invest our own capital. In 2007, the cracks were starting to show, and we were looking at the debt markets. But then in 2008, the market really started to falter, and we quickly pivoted to buying debt from banks, to buying foreclosures, to really getting our hands dirty and getting into real estate. Now, candidly, we didn't know what we wanted to do. We didn't have this grand vision, but as we started buying deals and, putting our own money in and inviting friends and family in and showing them, good service and good product and good returns, all the things that we expected as investors, it just sort of grew by word of mouth during that period. And it was only until, I would say, 2010, 11, the foreclosures, the bank debt really dried up. And we were gravitated more towards the value add, the ground up development space, and started our fund business around that. We just believe, and we started a fund for 2 reasons. Number one, we think it's a better way for people to invest. And number two, it provides a permanent source of capital for us. So when we're on the ground and we're looking to close deals, we actually have the answer, right? We have capital. Here it is, right? We don't have to go cobble it together from 50 people.
Right. Yeah, that makes a heck of a lot of sense. And that we're seeing so much more of that. It's like it's taken the industry a long time to catch on to that fund model. When you say you started looking at debt markets and things like that in 2007 and seeing the cracks begin to show, do you see any similarities in today's markets?
No, not from where we were in 07. 07 was a very unique, when you talk about the leverage that was happening, the leverage upon the leverage and the CDOs and the CLOs and everything else and the cracks in the foundation. And I think all that stuff has been cleaned up quite a bit. Is there risk today? Absolutely. I think the biggest risk to real estate today is probably interest rates. But that's no different than it was 2 years, 3 years ago. We don't know. They're ticking up. I think today they're at 1.75, and that's up from a low of 1.3 to 1.4. And it sounds like a big move, but it's still sub 2%. So they're incredibly low. Borrowing rates are cheap right now. I'm not concerned. We've seen, I would say in the last year, cap rates go from a 4 to a 3.5. But I think I think there's risk in the future of maybe a slowdown in growth rates and slightly higher cap rates and more like, I don't see a crash coming, but anemic returns. Now, I will tell you that just being in the market, seeing some of the prices that are being paid for certain real estate, I kind of scratch my head. We can't make sense of it. When you're buying, I'll give you an example, 10-year-old product, 20%, 25% above replacement cost. I don't get it.
Right.
And you have to put in, $10,000, $20,000 per unit. We're not in that market today. So we traditionally have operated in the core plus, the value add space. We're only in ground up development and then the debt today. And the debt is really preferred equity, mezzanine debt to protect ourselves. And then the ground up development is because if assets are trading at $400,000 per unit and we can build for 325, that just makes all the sense to us in the world. Because if the market comes back to 350, then we just make less money. But I'd rather build at 325 than buy at 400.
Well, for sure. And then, on top of that, you've got a brand new asset. I mean, that's,
Yeah, exactly. Right. And that 10-year-old asset, when you go to sell it in 5 years, it's going to be 15 years old. So, ultimately replacement cost is the governor in real estate. And that's what people have to remember, is that everything works on Excel. And in today's market, you can have a value add. It might work for a year or 2 years or 3 years, but eventually the ground up construction, the new supply does catch up, and the markets, water finds its own level in these markets, and the new product will outperform the older product.
right. And that, I guess that brings up another question though. At what point in time does the new product coming online, like you said, water finds its own level. At what point in time do you think that's going to catch up? Is there any end in sight right now?
The market today is actually, it favors ground up development because of the demographics right now. I mean, housing is in short supply. We're seeing it in the southern markets big time. I mean, you're down in Tennessee, you see it certainly in Nashville. I'm not as familiar with Memphis. The demographic shifts as of COVID have just accelerated. I mean, we've seen these demographic shifts happening for the last 3, 4, 5 decades, and these southern cities just growing, and COVID only accelerated that. But when you couple that, and you have to even look back to 2008 and understand why we are in a housing shortage today, is that we were way overbuilt in 2004, 5, 6, 7. And then for a decade, there was really no spec building because banks wouldn't finance it. Developers weren't out there. So many went out of business. And now we're in like this perfect storm because the millennials are coming of age where they all want to buy a home and they can't. So they're forced to rent and stay in rentals. And we do see some new housing construction picking up, but really what's benefited is the rental side, especially in the Southeast, the Texas markets, the Southwest. And we don't see that stopping or slowing down for the next few years.
Yeah, and I would agree with that. I think also the appetite has changed. The idea of moving into a home maybe isn't as appealing for people that can work remotely. They want to live in this city for a year or in that city for a year or whatever it is. Owning is not the same thing it was maybe 20 years ago. So I think that it just exacerbates the demand for especially multifamily housing today. Is that the only asset class that you guys are in, or is there other asset classes you're invested in?
Today, we are only focused on multifamily. We've done office, we've done retail, we've done some industrial, but as a company, we made the strategic decision about 3 or 4 years ago to only focus on multifamily. And it helps in a couple of ways. Number one, you streamline your operations around a single asset class. So when you're building a team, when you're building technology, when you're building the systems, the processes, all of that helps internally to be able to unify them all together, because office and multifamily, they're very different, and different systems that you use to manage those, and different people too. And to the market, it's just a better message when they know exactly what we do and how we do it. The only way to do, I think, multiple asset classes, if you're Blackstone, they can do that because they have companies within companies within companies. For us right now, we're 40 people. Our investment team is, between the acquisitions team and the asset management team, there are about 15 people. So it's important to specialize and really focus. And we found that the more we focus, the better off we are in both returns and, by the way, just deal flow as well. There's more deal flow when you do, less. And I know that's sort of contrarian. People think that the more you do, the less that happens. But we've actually found it's better to go an inch wide and a mile deep.
Yeah, absolutely. Absolutely. You guys, I'm going back through here, your track record of performance here. I think this is a document, I think that maybe even on your website, just your origin investments overview. I mean, there are some impressive returns over all of your different funds. What have been some things you guys feel like you do differently that other people aren't? Because I'm not seeing these numbers on a lot of opportunities that are out there right now.
Yeah, I think, you and I were speaking before, Sam, and it starts with alignment. And we put a lot of, just time and effort into building our platform. And we consider ourselves first and foremost risk managers. And the number one rule in investing is don't lose money. And that sounds easy, and absence of loss isn't necessarily gain. But when you underwrite conservatively and you have a filter that filters out the average and the below average deals, what you're left with are the really good deals. So we've never been a volume shop, and there's other firms that will do a lot more deals than us, but we've always focused on quality. And I think we have a really good team, and we have a keen sense of good real estate. And just the way we've designed our platform, we're a regional model. We have 5 offices around the country. We understand real estate on a local level. And I think we're really good at finance. We don't over leverage. And, there's a lot of reasons, but I do think it starts with that notion of alignment. My money is in these deals. David's money is in these deals. We're looking at this from our own investment capital. We have a saying, you only have to get rich once. We're not trying to, compete with technology and private equity, in the, seed stage and venture and things like that. We're trying to grow our wealth. We're trying to use real estate for what it's meant to be, grow your wealth, generate passive tax efficient income streams. And the old adage, you hit singles and doubles, and every now and then you hit 1 or 2 out of the park. And that's really what we're trying to do. And we've done that, and so it's just about repeating that and scaling up the organization so we can maintain quality while serving more and more investors.
Absolutely. That's fantastic. Let's get a little bit into the nuts and bolts of kind of what you guys are doing. If you guys are doing ground up development and you're doing it regionally, I mean, you guys are hiring general contractors to build this, or do you guys have the GC teams inside of your organization?
So we're a joint venture model. So we partner with sponsors on the ground, and that's how we've been able to scale. So we have longstanding partners in these markets that we're essentially the 95% equity in these deals. And that's the decision that we made a long time ago, is that we wanted to focus on asset management and investment management, because we believe there's a conflict of interest when you have all these competing businesses under one roof. There's an advantage to being vertically integrated, but when you have property management and you have construction and you have, investment management and you have all these ancillary revenue streams, it really is hard to balance. So for us, we'd rather come in when a deal is shovel ready, when a group has, they might have spent a year or even 2 years getting the deal entitled, and they need to get paid for that. But it's also why, we've structured our fees in the way we have. So our fees aren't really different than, going to a sponsor directly, because we've shaved them down at our fund level. But I think our product allows us to focus on a sort of a larger geographical region than if we were a sponsor, because typically what you find with sponsors is they're focused on a single city or a single area. And what we're doing is partnering with a dozen sponsors out there who are focused on those regions, but then our job is to really look broadly. And it gives us a distinct advantage because we can move across regions. If we don't like what we're seeing in the Southeast, we can move to the Phoenix market. We can move to the Texas markets. We can move to Salt Lake City in those areas. And so, there is a big advantage, to geographic diversity. And we saw this in, the recessions. If you go back to 2001, you look at that recession, and that was the tech wreck. And the West Coast real estate got decimated. Well, the East Coast, if you go down to Florida, if you go down to Charlotte and those areas, they didn't feel it. They didn't even know what was going on. Nashville was doing great and stuff. But so if you were a regional sponsor, you were in a recession. Well, the same is true of the last kind of 6-7 years. If you were in Houston, you were doing awful. Oil was on its butt. It wasn't doing well at all, but the rest of the nation was doing well. Houston has come back now. Right. And, we go back to 2008 and 2009, all the markets did kind of bad, but some did worse than others. And Charlotte was a banking community. So there is a big advantage of being geographically diversified and having that global view. And that's the decision that we've made, so we can be flexible. And by the way, if we decide to pull out, I don't have to worry about laying off 200-300 people who are in property management and construction, because that's not the business we're in.
Right. Yeah. Not like you said, not only do you don't have to worry about laying them off, but you can easily just then divert and deploy capital in an alternate market. That's absolutely brilliant. Talk to me about, by the time a sponsor gets big enough to, have projects that are worth you guys looking at what are they missing in their equation that they come to you guys and say, hey, we've grown, because it takes money and it takes deals to get to a size where you guys will probably want to participate with them. But then by the time they get to that stage, they may not need your money. How does that work? I guess, can you break that down as to kind of the synergies you guys find?
Yeah, a lot of sponsors, though, they don't want to raise the LP capital. They only want to use their own GP capital, right? They want to put the 5 and 10% and do multiple deals, because their operating platform is different than ours. They make money through the GC fees, and then they leverage their investment capital. And they don't really want to deal with the investor, and they'd rather have somebody come along and write one $25 million check then go into the business of investment management, where now they have to figure out how to raise capital, how to talk to investors, how to market to investors, how to service investors. And they just don't want that. So, some of them have done it and they've gone that route. But what we find is you're either a sponsor, right, on the ground, or you're an investment manager, right? You're the 90% equity or you're the 10% equity. And so, that's, we're not finding a shortage of sponsors out there who want, 90 or 95% capital. And what we've done historically is we help these sponsors out very early in the process, right? With GP capital, taking down land, providing soft cost money, things like that. And when we can get in early and we can do repeat business with a sponsor and we can help take the risk off that table, what that does for us is it gives us a contractual obligation and a deal pipeline to future deals. So one single sponsor, if we have a contractual agreement in the GP where we're helping them, grow their business as well, what we get in exchange is just great deal flow and a partner we always know. Because in real estate, and this, Sam, from being in it, the risk is in the partner. And once you've taken that risk out and you've worked with somebody over and over and over, you just want to keep working with that partner, because things will go, sideways, and you want to know the people who you're, who you're working with. And we'd rather have 6 partners than 60 partners.
Right. And that's what I tell everybody who asks me, how do I get started in investing? I've said, find people like and trust. That's step one. Forget about the deals, forget about the market. Find an operator like and trust. That's the first thing you do. Spend most of your time doing that. After you get that, the rest will take care of itself. So that's absolutely fantastic. Michael, I've enjoyed our conversation today. Thank you for coming on. You guys are doing awesome things, and you've certainly given us an enlightening episode here. Let's jump into the final 4 questions. The first one is this: what is one digital tool or resource you find you can't live without?
I've gotten this question before and I've thought about it afterwards. A digital tool, I mean, a lot of what we do, just making life easier in real estate, is Excel. And I hate to say that because real estate is not about Excel. It's the art and the science behind the two. But I do think Excel and the technology we use today has really helped make for greater efficiency of the organization. And honestly, my phone, the internet, everything we do just to make ourselves more efficient, and it's made the market a lot more efficient. So
absolutely. I love that. Next question for you. When it comes to investing in the world, what's one thing you're doing right now to make the world a better place?
Our mission from day one was to help high net worth investors grow their wealth, generate tax efficient passive income, and just bringing that institutional product to people like us, people who deserved a better way to invest. And when we got into this market, call it 15 years ago, we were investing our own money. This is even pre-Origin. It was dominated by non-traded REITs, and REITs are notorious for high fees and non-transparency. And this is pre-Jobs Act. And it really just, it hurt to watch how they were, making money and how much money they were making and how they were just, for lack of it, like in some ways, just fleecing people and stuff. And so we've always operated do the right thing, no matter what happens. And we always come back to that. And that's one of our core values that we talk about with our team. And there's a lot of hardworking people. Just because you're wealthy doesn't, you've earned your money. And the majority of our investors have enough to maybe almost retire on, but they deserve the ability to really use private real estate to their advantage and get the most out of it. So that's, I think, one thing, just globally as Origin, that I'm really proud of, that we've been able to deliver the results we have.
That's fantastic. That's absolutely fantastic. Michael, if our listeners want to get in touch with you or learn more about Origin Investments, what is the best way to do that?
origininvestments.com. Go to our website. We make it really easy for people to connect with us. You can download any material we have right on the website. You can connect with somebody from our investor relations department.
Awesome. Michael, thank you for your time today. I do appreciate it.
Thank you, Sam.